Hey, it's Brian over at Showcase Agency, and Eric, I want to thank you for taking our quiz, filling it out. I've got your results right here in front of me. Let me walk through it with you and show you what we came up with. So first of all, you're a first-time buyer, so some programs are only first-time buyers and others aren't, so it's good to know that. You're not a member of the military, so no VA loan. Now, you're looking in 3 different counties. So Orange County has a loan limit of $822,375 for conforming loans and also for FHA loans. So in Orange County, that's the loan amount we have to work within. When we get over to Riverside and San Bernardino, the limits are lower. And then there's one limit for conforming and then a different limit for FHA. So conforming is $548,250. And then FHA is $477,250. So we just have to fit within those numbers if we go out to San Bernardino or Riverside. Gross annual income, you answered no on $68,800 or less. Some programs are available to people that have that income and less. No loans in forbearance. Single family home, primary residence. That's important because if you were going for an investment property, it takes a bigger down payment. Let's see, how long are you going to keep the house? You say 7 years. When you're talking about keeping the house for 7 years or more, we want to look at fixed rate loans instead of adjustable rate mortgages. And then how much have you got for how much are you thinking of spending? It's $2,000 a month. That's going to end up being about a $350,000 purchase price for you. So we'll take a look at that in just a second. And then how much for down payment? 3.5%. To 5%. You can go either FHA or you can go conforming. Let's see, you're saying your scores average around 640 to 659. When we see the scores down in that range, you can get approved sometimes for a conforming loan, but the rate isn't that great and the mortgage insurance is really, really high. So we like to look at the FHA program. So I'm going to show you some of both, and you can see the differences there. But before I do that, let me show you the mortgage rate Seesaw and how that affects the interest rate, and then also the payment, or also the amount of money that you have out of pocket. All right, so let's check that out. All right, Eric, this is what we call the mortgage rate Seesaw, and it's really simple. When you go to get a loan program, almost all programs have a range of interest rates. So there's no one rate. You've got low rates and you've got high rates. Now, why would you go with a higher rate, right? Because when you go with a higher rate, then your payment's higher. Well, the thing is your closing cost, the money you have out of pocket, goes down. And the reason is when you go with a higher rate, you get a lender credit or you pay less points. Now, if you go with a lower rate, what happens is the closing costs go up, so you have more money out of pocket. But you do get a lower payment. Is the lower payment the best way to go? It's not always the best to go. A lot of it depends on how long you're going to stay in that loan, and then also how much cash that you have to put down on the home. So let's take a look at your home loan report, and let me show you your numbers. All right, Eric, we're over here at your home loan report, and the first thing I'm going to do is just switch the view. It's going to make it a little easier for us to see. And what I've got here for you, I've got 4 loan programs. The first 2 are FHA loans. Those are going to be your best fit based on your credit score. The second 2 options are conforming loans. They're also called conventional or Fannie Mae or Freddie Mac. Now, one thing, and I forgot to mention this, one thing that we should do is take a look at what we could do to get your credit score up, because if we can get it up 10 points or 20 points, that can make a big difference in your payment. And it might even be able to get you into a conforming loan, which is going to have better terms. So let's take a look at your first option. It's this one right here. It's a FHA loan. It's a fixed rate, which is great if you're going to keep the house for 7 years or more. And it has a 3.5% down payment and a 2.25% fixed interest rate. So at a $350 purchase price, that's going to put us right around that $2,000 payment that you were saying you're looking for. So that's a $350 purchase price. You put 3.5% down. There's your 2.25% interest rate, and it's going to take about $19,000 out of pocket, about $19,200. So where's all that money going, and what does the payment breakdown look like? So, I I did that kind of fast. There's a button right here that says more info. And if you'll click on that, you can see the payment breakdown. So right here it says payment breakdown. And you see the monthly payment we just looked at, $1,973. What does that go towards? $236 goes towards your mortgage insurance. $58 goes towards your hazard insurance, or sometimes it's called homeowners insurance. And then $364 go towards property taxes. So $1,313 out of this payment actually goes towards your mortgage to pay the balance down and to pay the interest on the loan. Now, what if you wanted to know about the closing costs? You wanted to see a breakdown of that. Click on the closing cost button, and you'll see you can take a look here. Click on the fee detail. I'm not sure if you saw that. So click right here on the fee detail, and that's going to show you a breakdown of the closing costs that you've got. You've got fees that go towards the appraiser, towards the escrow company, the title company, the county that you purchase in. They have fees for recording the deed. And so there's different things there. But your closing costs are not all third-party fees. Some of them are fees that go towards what are called prepaids, and that's where you're paying in advance for some things such as your insurance, your homeowner's insurance, or your taxes that might come due. Or they would go towards what's called reserves, or sometimes called impounds. And that's where the lender sets up an account for you called an impound account, and they set aside some money every month for your taxes and your insurance out of the payment that you're sending in. That way, when the taxes and insurance come due, the lender should have the money in that account so that they can make that payment on your behalf. So that's what you're seeing here when you see these reserves. This is money that's set aside for the taxes and the insurance. And that money that's set aside varies based on time of year that you close and when the taxes are due. So hope you found that part helpful. Let's go back here to where we were, and let's look at these options again. So this one's $1,973 payment, $19,000 cash to close. Well, what if you didn't have as much cash to put down, or you didn't want to put as much down? That's where that Seesaw comes into effect, right? Because we're still at a $350 purchase price, but what we did here is we increased the rate from 2.25 to 2.875. And once we did that, what happens is we get a credit, and so our cash out of pocket goes down. Your payment's $2,085, but the cash to close went down almost $6,000. So it went down to $13,679. All right. Let's look at these conforming options. They're not going to be your best options. They're going to still give you a payment around $2,000, but the cash to close are two of the highest, and it brings down your buying power. It brings you down to $300,000. This one here is 3% down, and it has a 3.25 rate, and this one here is 5% down and a 3.25 rate. So you can see that the FHA loans are going to be your best option. But again, I think we should take a look at, or whoever you work with, you should take a look at improving your credit, because it might not cost you anything to improve it, and it might be pretty easy for you. There's a couple of charts in here, monthly payment difference, just so you can see the difference graphically. Now this is a good one. This shows you which loan is actually the least expensive and the most expensive over time. So you can see that here. That's the difference in the savings. And this is a really important one. This is your net worth in 15 years. So let's say you're going to hang on to this house for 15 years. You would actually, because you're paying down the loan, but the value of the home is going up, what happens is you create equity, and that equity adds to your net worth. So if you had $1 million home and you owed $300,000, the difference is $700,000, and that would add to your net worth. So buying a home is one of the best things that you can do to really start to supercharge your retirement, supercharge your net worth, your finances, and this is a good chart. It just kind of shows you that. Now let me show you what kind of income is required to qualify for something like this. Let me jump over to that. All right, Eric, this is what we're going to look at right now is the income that's required for a $2,000 payment. And that's going to depend on a couple of things. Well, it's going to depend on how much debt that you have. So let's say that you've got no debt. Well, we have to fit your DTI into 2 boxes. We have to fit it into a front ratio of 47% and a back ratio of 57%. So what the heck does all of that mean? For the front ratio, that's your housing expense. So we take your $2,000 estimated payment, we divide that by your income, and we've got to be at least 47% or less on that number. So that's going to mean for if you had 0 debt, you're going to need $51,072 in income. Now let's say that you had some debt. Let's say you got a car payment or something. $500 in debt. That's going to mean that you're going to need $52,632. Now the reason is we've got to fit in that 47% box, but we also have to fit in the 57% box. The 57% box is the back-end ratio, and that takes into account not just your mortgage payment, but also anything that's going to show up on your credit report. So all your minimum payments. So car leases, car loans, installment loans, credit cards, those are the things that we would count the minimum payments. Things that we wouldn't count would be like a utility bill, cell phone bill, things like that. So on the second or this middle column where you got $500 in debt a month, that means you're going to need $52,632 a year. If you had $1,000 in debt, that's going to mean you need $63,168 in debt. Now, in income. Sorry about that. So I mentioned earlier county loan limits. They do change from county to county, but they also change based on the number of units. So if you're interested in a single family, that's going to be 1 loan limit. If you're interested in, or I shouldn't say single family, I should say 1 unit. But if you were interested in a 2 unit or a 3 unit or a 4 unit, each time that there's 1 additional unit, the loan limit goes up. So if you want to check that out for FHA and conforming, I put some links in the description here in YouTube, so you can just take a look at that. And if you're ready to buy and you see a home that you want to go check out, just text our office the address and we'll set that up for you. And there's no obligation, there's no sales pressure from us or anything like that. And if you're ready to buy and you want to get pre-approved, you can get a buying power pre-approval from us. And the link to that is also in the description. And if you're not ready yet, you're probably just gathering some information at this point, check out our website, showcaseagency.com. We're constantly adding new content, and also check out our social. And if you have questions, just text our office, and one of our licensed experts will get back with you, very quickly. So, Erik, I hope you found this helpful. Thanks again for filling this out. It'd be great if you could leave a comment below, let us know what you think of it. And if you have any questions, reach out. That's what we're here for, and we're happy to help. All right, take care.